Welcome everyone to another webinar presented by Hack the Markets. I'm AC Hall, the founder and CEO of Hack the Markets. And today, what we're going to be talking about is basic trading strategies. If you guys have been following along the webinar series that we've been putting together, me and my team, you would see that first off, what we talked about was actually getting into the stock market. So selecting a brokerage account, actually funding that account, and then understanding the different order types that you have available and things of that nature. We then moved on. My colleague Raheen, he actually went over what type of trader are you, so that he can help you actually define what type of trader you are, so you can develop a strategy. Um, that's pretty much based on what you're trying to do. Um, that being said, if you're trying to be a day trader, of course, you're not going to be expecting to be in a move for 2 months. You're a day trader. Same goes if you're a long-term investor. You're not going to be trying to get in on a play and getting out of a stock or whatever instrument you're trading at the time, whether it be an option or a stock, commodity, future, whatever it is. You're not going to be looking to get out of that thing on the same day. So just putting things into perspective and actually getting you guys accustomed to the different time frames and things of that nature. And he did a very good job going over that type stuff. So today, like I said, we're going to talk about some basic trading strategies. Right here, we have a list of commonly used indicators. Um, I use indicators. I'm not a huge indicator person, but I will use them every now and then. And on this list, I say that I use the moving average, I use the exponential moving average, I use the Fibonacci retracements. Um, I used to use the MACD, the RSI, and the Bollinger Bands. Nothing wrong with them, and that's why I'm still going to go over them, because a lot of people still track that stuff, and it's still some good information to have, and still a good indicator to take a look at. Not necessarily saying make all of your trade decisions based off of this, but it does help you out with actually trying to build a direction or trying to understand the strength of a market, whatever that indicator is built to do. So let's go ahead and step into it. The first thing that we're going to talk about is the moving average. So this right here is an indicator used to identify the direction of a current price trend, but it doesn't get interfered with by short-term price spikes. So it basically smooths those price spikes out by taking just a moving average over a defined amount, defined period. So this is also called a simple moving average, SMA. Your trading platform may call it a just regular moving average, may call it a simple moving average, may call it a SMA. So all of those are the same. Next, we have pretty much what it does is, like we were saying, it takes the average of price over a defined period of time. And some commonly used periods are the 50-day moving average, the 100-day moving average, and the 200-day moving average. And the way that you set these things up is you just go inside your trading platform, you find that moving average indicator, and it's going to ask you for a period. You will put in, if you're on a daily chart, of course, each candlestick is going to be worth a day. If you're looking at a candlestick chart, you're looking at line charts and things of that nature, you're just going to know the end price. So what it's going to do is it's going to look at those prices, and it's going to average those prices, those ending day prices. And what it's going to do is going to spit out a number. And that price is going to definitely smooth out. It's going to be more of a smooth line and not as jerky as you see on candlesticks and things of that nature. So good indicator to use. A lot of people like to use these as crossovers. So what they like to do is sometimes they'll put in like a 10-day moving average or something like that. And they'll have something very short term that kind of like just moves very quickly with the stock. It kind of like almost makes its own trend line in a sense sometimes, especially when the stock is trending. And what they would like to do is, so with these numbers that we have on the screen now, the 50, the 100, and the 200, What they would like to see is the 50 above the 100 and the 100 above the 200. If that's the case and those things are kind of like moving away from each other, what they would say is that this is a uptrending market. Same goes if the 50 day is below the 100 day and the 100 day is below the 200, they would say that this is more of a bearish market. It's going down. Very quick, simple technique to use. Gives you a really quick idea of direction of the market. And we talked about using this on the daily, but you can definitely use this on any time frame. You can mess around with different time periods as well. So mess around with it, come up with something that you actually like, you know? We'll move on now to the exponential moving average. So this is pretty much the same as a moving average that we just talked about, but it's not as simple. It's an exponential. So that's where we get the difference. The difference is that this indicator, of course, too, is used to identify the direction of a current price trend without the interference of that short-term price spike, because that's going to get taken care of when we're taking the average. But this takes it a little step further, and it places greater weight to the most recent points. So the most recent data points are going to have a little bit more weight than older data points, and that makes it more responsive to newer information that's entering into the market. That could be very useful. And of course, we all know that something that happened 5 minutes ago is going to probably have a little bit more impact on the market than, say, something that happened 2 days ago, depending on the severity and how strong that news event was. So we definitely can see how the exponential moving average can be a little bit more beneficial. It responds a little bit quicker than a simple, but that's really the main difference. Outside of that, the simple and the exponential are pretty much the same. The exponential just does put a little bit more weight on the most recent data points, and that's what helps. That's what helps you out with being a little bit more accurate with the price. No indicator is 100% right. So with that being said, don't try to just pick one indicator and think that you're just gonna have you just found the holy grail of indicators. And that's why I say, like, I usually don't use indicators, but I will use them. And especially like these moving averages are one of my favorites. um and exponential moving averages, pretty much the same as what we saw with the moving average right here. The commonly used periods can be the 50 day, the 100 day, and the 200 day. So let's go ahead and step over one more time and let's look at the MACD. So MACD is something that we look at. It's pretty much the moving average convergence divergence, and that's what this indicator is about. It's used to detect momentum of a stock, and so pretty much very useful indicator to use when you're at support and resistance areas. These are pretty much those flat spots that you see on the price chart, where support area would be considered like a floor, resistance would be considered like a ceiling. So, with that being said, the term divergence, of course, indicates that the moving averages are moving further away from each other. So, if the moving averages are moving further away from each other, then that means that the momentum is increasing. And then the term convergence indicates that the moving averages are moving closer together. So, with that being said, momentum is decreasing. Very quick, very simple. You can actually use the MACD, like what people usually call it, to put in your moving averages that you were using earlier. So that's a strategy that you can use. You can use a MACD and you can actually put in 50-day moving average or 50 period and a 100 period, and you can have the MACD kind of tell you if this thing is getting further away, meaning that the momentum is increasing, or if it's converging back to each other and so it's decreasing. So very good tool. One thing that I will say, one caveat, all indicators do lag. And that's one huge reason why I don't really like them. But at the same time, they're good confirmation tools. So if you're in a trade and you're looking around and you're just trying to get a confirmation for something, you may have jumped in a little earlier or something, it could be used as a confirmation tool. If you just open your trade specifically off of the confirmation of one of these indicators, that right there would put you in the trade. Probably have a good trade, but like I said, you'll probably miss a good part of the move. I'm not going to say a majority, but you'll probably miss a good part of the move just because the indicator lags. And so that's the only caveat that I have to indicators. So let's go ahead and let's move over to the next thing, which is RSI. RSI, which is Relative Strength Index. And this is an indicator used to identify market conditions or the strength of the market. And it's usually expressed as a number between 0 and 100. And what this indicator does is it shows if the market is overbought, and that's when you see a reading over 70, or if it's oversold, and that's when you see a reading of under 30. And so when it is overbought, you should expect to see price start moving lower. And that's because the strength of the market has pushed it up. Prices has gotten a little bit too much. People have overbought this thing. And so we would expect to see prices start easing a little bit and start heading lower. When we see an oversold signal, we would expect to see price start moving higher. So with that, that's like the pressure of the sellers have come in and they have oversold the market. They overshot the target. So they've just went in and they've just oversold. They've just sold too much. So with that being said, you would expect to start seeing the price move higher. Now take it, this does not guarantee anything. So just because you see that RSI is in overbought territory does not mean that it's going to head lower. And when you see RSI in oversold territory, that does not mean that it's going to go higher. It's a good indicator. It's something to look at, but it is not something to hang your hat on and say, this is a definite thing that's about to happen. So let me put all my money down on this. And this RSI is telling me that everybody's dumped. So I'm coming in to buy. I wish it was that easy. If it was, trading would be awesome. A lot of people would be rich, but it's not that easy. So again, take it with a grain of salt, but use it as something that validates what you're looking at, or another tool to kind of like look for opportunities, but not necessarily end all be all where you're saying that because this thing is oversold, I'm going to buy, or because this thing is overbought, I'm going to sell. One of my favorites that I like to use a lot is the Fibonacci retracements, and this is what we're talking about right here. It's basically based on a mathematical sequence known as the Fibonacci sequence. We don't have to go into detail about all of that. I was a math major. I'm not going to go into all of that. Half of the stuff I forgot myself anyway, but just know that this is an infinite sequence that pretty much goes on and on and on, also known as the golden ratio. That's all we need to know. And what it is it's used in trending markets to pinpoint levels the market will pull back or retrace to. And that's what we talk about with retracements. It's like a pullback, or basically once you see price go up far enough and then it starts heading back lower. Once it starts heading back lower, that's the pullback. You can look at a variety of stock. You can look at Tesla and things of that nature. You can see that right after that huge run up after the split, they go up to almost $1,000. I think it was like $800 or $900, or they went up pretty nicely and then they pulled back. Like, it's a lot of pullback. So whenever you see that initial move up and then it pulls back, that is, the pullback. So Fibonacci retracements pretty much give you an area that you can kind of pinpoint to look for. And it's not 100%. It's not going to give you 100% accuracy, but it is going to give you a level to kind of put focus on. And some of those key levels that we like to look at are the 381 retracement, the 50% retracement, and the 618 retracement. Those are like our three key numbers. Outside of that, we don't really like to use a lot of other numbers. It's a lot of other Fibonacci numbers out there. A lot of other guys talk about different techniques and different patterns that they see out of those other numbers. For me and my team, we don't really look at it. We just look at these three key levels right here: the 381, the 50, and the 618. Whenever it gets close to one of those levels, we're just gonna observe price. We're gonna see what it's doing. Um, if it's doing something that we like, of course we take the trade. If we see that it's not doing so hot, or it's kind of breaching that area or anything like that, um, if it's not if it's if it's not following our rules and it's breaking one of them, we're not going to go and chase this thing. So just a good tool to try to pinpoint levels, but like we said earlier, nothing is 100%. So it's just giving you an awareness to certain levels and letting you be proactive about knowing that this area could possibly be something. Um, like I said, one of my favorites though. Use it all the time. So now we're on to our last thing, which is the Bollinger Bands. This is the last indicator we're going to talk about today. And this indicator provides a range that price usually trades within. And is usually used also to gauge the volatility of a stock. So whenever you see these bands are really, really tight, that means that the perceived volatility is low. And whenever you see the bands are very, very wide, that means that the perceived volatility is high. So whenever you're looking at Bollinger Bands, if you ever pull them up, you'll see a boundary. You'll see two lines come up above the price and below the price. And whenever those things get close, that's what we're talking about. When they get tight together, perceived volatility is low. And when they get wide, that means the perceived volatility is way higher. That could also play into part with options. That's a little bit more complex and out of the scope of what we're talking about today. But that volatility is definitely something that you would want to know about if you were trading options. That is something that we go over inside of Hack the Markets, as well as a whole plethora of other trading strategies and techniques. We have our own in-house techniques that we like to deploy as well too. And we teach all this information. We have a lot of webinars and internal calls and things of that nature, and material that we just love to share with our clients. And so if you're interested in any of that type stuff, most definitely head over to hackthemarketstrading.com. It should be scrolling along the bottom of the screen right now. And you can actually subscribe to our YouTube channel, and you can get access to a lot of good information. We also produce a podcast that comes out every Monday, Wednesday, and Friday. So that is some good information that you can use. Comes out in the morning time, so you can kind of check it out right when the market opens, or a little bit before the market opens, whatever you prefer. And you can actually get a pretty good roundup of what's going on news related and what our picks are, what we're looking at. And, we just like to provide that information and just help as many people as we can on their trading journeys. So I hope that you enjoyed this video. I hope you enjoyed this webinar series. And we're going to continue producing a few more videos. So stay tuned for that. And happy trading, guys.